Welcome everybody to today's webinar. I'm really excited for today because I think this is probably one of the most topical sessions that we've had in a while, specifically on probably one of the most challenging pieces that many of you have questions for us or that we hear for different client visits or even in conferences, which is cycle time. And yes, speed matters. So I want to introduce some partners of ours and kind of dive into today's discussion. But Jim Gladden, SVP of Origination Strategy over at ServiceLink, and Barry Coffin, Managing Director of Home Equity Title and Close over at ServiceLink. I've known Jim and Barry for a number of years. I was actually a client of theirs long time ago, but great partners, great solutions, and I think today's webinar on speed matters on home equity cycle times is really relevant, just given the fact that they have great solutions. We have the data that kind of backs up the problem and not necessarily the solution, but where the problem statement is and where those areas of opportunities are. So Megan did a nice job of kind of teeing up who Curinos is, but just to tell you a little bit more about who Curinos is and how this data is relevant today. Curinos helps depositories, banks, credit unions, also fintechs, IMBs, really across the balance sheet. But where we're going to specifically talk today is our lender source data, specifically in origination benchmarking. What Curinos does is kind of across the board on all things lending. But as you think about pricing and fees, think about it as the rate sheet data. So this is lender sourced, named lender. How are lenders priced today in the market for specific products and credit tranches, to the origination benchmarking, which is lender sourced actual applications, funded transactions that are happening on a weekly basis, giving you a near real-time sense of what's happening in the market. We do this across home equity, first mortgage, unsecured lending, and small business. But today's topic is specifically going to use that data, transpire into the use cases that we're going to walk through today to kind of uncover why speed matters. We're going to use a little bit of our data on the portfolio benchmarking to really talk about why speed matters in terms of usage of HELOCs. So this is a separate benchmark that we have that's covering the actual performance of HELOCs and HELoans once that loan books, looking at utilization rates, looking at draw behaviors, draw balances, and certainly the delinquency trends. Let me hand it over to my friends over at ServiceLink. So Jim, tell us a little bit about ServiceLink and how you work with lenders today.
Yeah, thanks, Ken, and great to be here. Appreciate the opportunity. So for the audience out there that may or may not know us, so ServiceLink is the national mortgage services platform of Fidelity National Financial. For those that may not know, Fidelity is the largest title insurance underwriter in the United States, a Fortune 500 company. And ServiceLink, being the national lender division, we focus on lender-directed products and services. So those would be focused in the origination space and the default space. And as you can see here, we work with a number of lenders in the top echelon of their business tranches, but we also service all the way down to the smaller lenders as well. The unique thing about ServiceLink is that with ServiceLink and some predecessor companies, we've been in this business for, as it's noted here, for 55 years. So been through a lot of cycles, been through a lot of credit policy changes. And so what we've been able to develop over that particular period of time is the product and service mix that ties into what our clients are looking for. And obviously today we'll talk a lot more in detail about how that mix ties into the home equity product space, how we're applying that today, how we're working with lenders for that as well. And then the last thing just to note on this particular slide for you is that ServiceLink is a large organization. We have over 2,000 employees that are part of ServiceLink, spanning the origination and default space. So sort of been here through thick and thin, as I mentioned, seen multiple market cycles, and look forward to seeing the next cycle. And as Ken was referencing here, and you'll see within the deck, a lot of opportunity and things continuing to grow in that particular space. So thanks. And I think I can turn this over to Barry, who can talk a little bit more about maybe how, as I mentioned, those range of products, how that sort of aligns and what we've built here today. So I'll turn it over to you, Barry.
Yeah, thanks, Jim, and thanks everyone for joining. So as the slide points out, it shows all the different products that ServiceLink has available to our lender clients. And if you look at the chart, it goes from lower risk concern around some of the products all the way up to a higher risk concern, depending on the product and credit risk profile that a lender would have. You know, as we focus on home equity type products, we certainly understand that cost is a factor. We also understand that coverage is a factor. We also understand that having a wide variety of products to meet a client's needs is a main factor. And I think you'll find here, especially as we go through this deck, that ServiceLink has all the available products that a client would need. As Jim mentioned, we're a national provider. We support clients that deal on a national basis, but also clients that deal regionally or locally and so forth with these different products that we have. You know, if you look at the valuations and so forth on what people are focused on from a home equity perspective, you know, a lot of AVMs are being done, a lot of property condition reports, but you can see the cascade as it goes all the way up to an interior appraisal if needed. On the flood side, certainly full flood services here at ServiceLink as well. And then in the title space, where we focused a lot of our efforts around automation, speed, returning titles as quickly as possible, you know, we have a cascade of products to meet any need there as well. The Instant Property Information Report is our sale tool, where we can provide data on the property around the consumers. Are they vested in title? How many open mortgages? Are there any liens? What's the status of taxes and so forth? At point of sale to help a lender client determine, can I fast track this loan? You know, one thing that we have the benefit of here at ServiceLink is we work with a lot of different clients across a lot of different lending spectrum, and we're always listening to them. I can say in this Speed Matters talk that almost every lender client we work with is looking to reduce cycle times. You know, so we work with a lot of different lenders, and pretty much everybody's primary goal is to reduce cycle times. And a lot of what ServiceLink is focused on, you know, both operationally and from a tech perspective, is helping the lender clients do that. And then, you know, the title line goes from any uninsured products, if that's the need, all the way up to a full title insurance product as well. And then on the closing side, we've done a lot of work on the closing side to automate that particular process as well. You know, we work with lender clients who want the idea of having multiple title providers. We certainly understand that, but because of our closing experience, we found that we have several clients that will use us 100% for signings. You know, and that goes directly from the type of signing they may need, be it an e-closing, be it an IPEN, be it a wet signing, a traditional signing. But starting with consumer scheduling, the ability to schedule loans, having the consumer do it or having the lender do that. And we'll talk more about that later on as we get into details, all the way up to full escrow services as well. And one of the things that we're hearing, back to title real quick, is providing a title grade and doing title curative. So all these other things that will help a lender push the loan through to approval is offered by ServiceLink and available to all of our lender clients. So I'll pause there.
Super. Thanks, Barry. Thanks, Barry. Thanks, Jim. Yeah, so a lot of what you see here on the page, we're going to integrate into not just by why speed matters, but, you know, solutions that actually can make a meaningful difference in your total fulfillment process to be able to incrementally improve your overall cycle times. So let's talk a little bit about where we're going today. I'm going to give everyone just a very brief snippet on current home equity operations landscape. We'll segue that into just the topic of today's call, which is why does speed matter? And then we'll talk about, you know, kind of the borrower behavior there of that opportunity cost of speed. So if you are not pressing to get faster, if you are not actually making improvements day by day, month by month, What are you leaving on the table? And then really a takeaway of what lenders should be focusing on right now. We're going to throw a lot of info on the table today. It's all going to be very timely topics. Many of you will probably identify with, but we want to leave everybody at the end with what are some things that you should be thinking about right now, or specific things that you could be implementing as of today to be able to make that incremental progress. So let's talk a little bit about the operations landscape. Can't talk about the landscape without giving a sense of what is the health of home equity today. So if we think about on the page here, so again, with Curinos' data and home equity, we get a weekly flow of our benchmark of lenders. So we're seeing a very timely snapshot of every application that's being done, as well as all of those applications when they actually book. So we can see the cycle times, we can see the pull through, but obviously is reflected on the page here, we can see just what is happening in the market in terms of demand, as well as the booking performance. So this data was captured through the end of February, so we just have a nice clean end date there. So you look at this and say, Ken, you just boosted home equity up and just, put it on top of the clouds there, but you're saying applications are down year over year by 5%. I'm going to come back to that. I've got a good story for you. But if we look at where we are in bookings on the right-hand side, we're coming off of a really good growth year, double-digit growth at 16% annualized growth. And year to date this year, we're up in bookings about 4%. So I feel really, really good having a Q1. We're actually in positive territory. And then from a forecast perspective, Curinos does have a proprietary home equity forecast model that we've been really, really close to actuals for really the last 15 years. We're gauging somewhere in that 5 to 7 space. We put kind of 6% on the page. We do think a lot of that growth is going to be in H2 of this year, coming out of the gate strong at a 4% growth, and mostly a rather seasonal month, and it's really challenging to get traction early in the year. I think we're off to a really, really good start. But just very, very briefly, why the minus 5%? You have to remember this is a year over year snapshot, not a month over month snapshot and so on. But if everybody can take themselves back about 12 months, we were coming off of one of the best Q1s in application demand that we have seen in a number of years. Well, why is that? Take yourself back to Q4 of 2024. What happened? We got the first series of rate cuts in a very high elevated rate environment that we have not gotten. We were all hoping for a long time. So we saw a lot of that pent up demand. So a lot of those applications were pent up demand. We saw a big boost in Q4, but we got shot out of the cannon in Q1 of 25. So we saw huge growth. So to be able to say we're down 5%, I feel you. We want to have incremental growth year over year, but that was just a really, really big number in terms of total application growth at the start of the year. And again, with seasonings of pipelines, again, a lot of that was carrying over. So we're seeing good traction on the bookings, applications, kind of a false positive story, but I still feel really, really good of what's happening in the market right now in terms of total demand. On the other side, on our portfolio benchmark, we kind of like to look at both sides of, we're seeing the demand, we're seeing the bookings, we know what happened last year, our balance is actually happening. So this is what we call a balance waterfall that we produce for our clients. But this is looking at it from a benchmark view of what's new to book for HELOCs and HELoans as a result of like actually funded dollars on HELOCs and the closed balance on home equity loans. New draws will be the capturing of what are HELOCs doing in terms of incremental draws from existing HELOCs on books, and then the pay downs and payoffs. So I won't go through each detail. Obviously, you're going to see positives on the draw side, negatives on the payoff and close. But the number here that we look at is for 25, we had a 16% origination growth rate. We're only seeing a 5% incremental growth in total UPB, or that total balance figure. There's a lot of moving parts there, but the short story here is we are seeing a healthy amount of pay downs. We are hitting that 10-year wave again this year and next year with end of draw HELOCs. So we're seeing a pretty decent amount of runoff from those older vintages. But also, again, part of what's part of today's storyline is we're just not capturing the balances. We're inflating that origination number. We're not actually capturing net new balances at the same clip that we're actually originating those bigger line commitments on HELOCs. Not to deflate the sale here of anybody big on home equity. I myself am very bullish on home equity, but certainly an opportunity for incremental growth on the balance side. So to start narrowing the home equity landscape here, this is a view with our data that we can break out by institution type. So we have in here banks, credit unions, fintechs. Think of that as more as the non-banks, and won't name them by name, but you guys know who they are. It's pretty obvious here, what the level of separation is. If you look at that average on cycle times, we're sitting right now at about 34 days. So we're down a little bit, but we're still north of 30 days. Then you can see banks on average are higher. Credit unions on average are about almost 10 days higher on average. Then you have the fintechs down here, about 17 days. So I've got another view to show you as we go in later on cycle time distribution, but this is really going to be the essence of what we're covering today. Is I don't think anybody here that can identify with a 30+ cycle time number, I don't think anybody is patting themselves on the back. You're looking for ways to get incrementally better and be able to better serve your members, be able to serve your customers, your households, be able to deliver on that product faster. Quick view of geography. So across the states, kind of see where things sit as of the last 6 weeks. Up to this most recent week, this past Sunday. And then we carved out here, what does the best cycle time look like in the top 5 best cycle time states, and then the bottom 5 states. I'm not going to say the worst, I'm going to say they're in the bottom 5. So you can see here, the best of the best, you're looking at North Dakota, Ohio, Rhode Island, Montana, they're all sitting just under 30 days. So that difference between kind of a midpoint and as the best performing states, you're still in those upper tranches, almost still reaching 30, and then you're into the mid to even higher 40, even 50 range when you look at some of the bottom states. In terms of pull through, so again, because we get that timely snapshot on applications and then later on the bookings, so now we can measure what that total pull through looks like. So don't be deceived because January shows down. That's because if we're averaging 30 to 40 day cycle time, a lot of those January applications haven't seasoned yet. So you generally see a bit of dip there, but that's for lack of seasoning on those pipelines. So you can kind of see where these fall. Second liens are generally always in a better pull through position versus first liens. So on average, we're sitting at around just north of 40%. Then we got to go all the way down to about 30, even under 30% for a lot of home equity loans. So this is what some of you might call a closed-end second or first lien home equity loan. They're generally in the 20 to upper 20 territory. So what's interesting here when we look at the pull-through metrics, and I did us a favor and backed this up to December just so we could get a true seasoned standpoint here. There is an absolute correlation to states that have the best cycle times, generally have the better pull-through, as well as the bottom 5 states that have the highest cycle time, so the bottom 5 performing with a correlation of the bottom 5 pull-through. So this piece right here is, again, I think going to be a very fundamental piece that we translate going forward is speed matters. And if you take a state like Texas, also in that bottom 5. Texas, I know, Texas lenders, I'm sorry, it's a really challenging state to work in. There's lots of hurdles. But when you think about the speed to close and being able to help borrowers, help members that have a need today, need that roof replaced immediately, they can't wait in line for 40 days. They need that. So a lot of that fallout, according to our data and the feedback that we get from a lot of our clients, is there's a lot of withdrawals, there's a lot of walkaways of, hey, a home equity is the best product for me, but if you're not going to fulfill this within a respectable time frame, I'm just going to put it on my credit card or get an unsecured loan or go to a lender that can deliver this within just a couple of days. So again, speed matters, and the element of, from a state view, we're going to get down to some specific use cases on why does speed matter and why everybody should be striving for that incrementally improved cycle time metric. Jim or Barry, I know, I apologize, I was supposed to kind of pause and ask you a question there, but as we think about overall cycle times and we look at the top states and the bottom states, what would you guys attribute as one of the biggest challenges or biggest hurdles that's impacting lenders today, and that keeps those cycle times elevated?
Yeah, so Ken, when we look at the different types of lenders and where you have shown that their average cycle times are and so forth, what we identify, because we have the benefit of working with multiple types of lenders, so we work with all of those institutions that you outlined on the previous slide there. What we find is that the fintech lenders that we work with are really quick to adopt any of the technological advances that are out there. They're constantly looking at turn time and cycle time and looking at the products that are offered to help push those loans through from application to booking as quickly as possible. So that's what we see with fintechs. They're quick to adopt it. They were quick to adopt e-closing. It really hasn't grown exponentially like we thought it would, but it continues to grow, and more lenders are doing e-closings and so forth, taking advantage of our consumer scheduling tool, which allows these lenders to reduce, just by using consumer scheduling and our real-time calendar for our notary panel. We find that it takes on average 2 to 3 days off the cycle time just by using that tool, where we're finding the consumer picks the first available date available to them. So I think one of the biggest things that lenders can do is adopt technology, talk with your providers, talk with ServiceLink on what we can do to help you reduce any of the hurdles that you're seeing internally, and see if we have a solution. If not, ServiceLink does do a lot of tech work, and if we don't have it yet, we'd certainly look to build it.
Yeah, that's great. You and I spent some time together, obviously, prepping for today, but, I think one of the big takeaways, on what you said is, that incremental improvement, 1 to 2 days might seem insignificant. We know that you want to improve cycle times by weeks, not days. You don't get there overnight. How you get there is that incremental improvement of starting with those 1 to 2 days. And we're going to spend some time on this with that e-close, and looking at some of our data on that, app to approve to close, and just looking at like trimming a couple of days here and there can make those bigger improvements. But for today, it's not about boiling the ocean. We got to figure out how to start making some of those slight changes that are going to make a much bigger impact in the long run.
Yeah, exactly, Ken. And you're talking incremental from the beginning, right, all the way through to the closing piece. That was just one example, but saving time on instant property information, saving time on industry best turn times, all of that adds up to the end goal.
Great. So with kind of the landscape out of the way, I'm going to walk through a couple of views from our perspective of why do we think speed matters. I hope all of you that tuned in today will draw your own conclusions, but we firmly believe speed matters for a number of reasons. One specifically, and just stick with me here because I'm going to tell a little bit of a story and where we're going, is just making sure, you have to understand who your customer is, but also how customer preferences are shifting, what that landscape looks like. So a couple of things on the page here. This is a recent snapshot of total debt outstanding by the consumer age brackets. And this all makes sense. Some of the older generations over in here, we still have a healthy amount of mortgage debt, but overall consumer debt is materially lower as compared to kind of the middle age generational brackets, and certainly compared to the much younger, the 18 to 29. So number one is, you think about this, is the home ownership rate in those older generations, we'll just pick on Gen X and Boomer kind of on the right here. The total consumer outstanding debt is much, much lower, but the home ownership rates are extraordinarily higher. The debt is in that middle range. It's going to be in more that millennial space, a little bit of Gen Z, a little bit of Gen X, but that millennial space is predominantly where the most outstanding debt is, right? But that's not where the more predominant homeownership space is. So this idea of who is the target customer? Is it the customer that has all the equity but doesn't have the debt? Or is this target customer the borrower that has all the debt but minimal equity? I don't think there's a right answer there, but I think it is a healthy balance in between the two. And ultimately, the reason we like to show this slide is to help understand of where that target demographic is in terms of where that opportunity is, because this view right here is using Curinos' recent shopper study data. And this is looking at a same snapshot of the different generations there. And this is going out and surveying thousands and thousands of consumers and saying, based upon where you fall in that generational bracket, we asked the question, what is your preferred method of opening a complex account? And for this definition, opening a complex account would have that mortgage and or loan type of product included in there. So again, we take you back to that previous view of high home ownership rates, lower overall debt. Those older generations much prefer in-branch methods. They want to talk to somebody, they want to drive somewhere, they want to go in somewhere. They're not as comfortable and not as much preferable to digital channels or doing things over the phone or like video chat. But you go to those millennials and those younger generations, we're now at more of a 50-50 split, right? We have 50% of those in that kind of middle range bucket saying, I don't want a branch. I want to do things from my home and from my iPad and not have to go anywhere. I don't want to have to go to a branch. Make things convenient and make them easy for me. Most importantly, make it fast for me. You don't want this to prolong for 30 and 40 days. Just make the process easy and fast. So as we continue on this idea of the consumer sentiment or the consumer mindset is shifting of, again, I don't want to have to go anywhere. I want things faster. We have to think about this in terms of cycle times of, is 30-day cycle times really going to appeal to that broader market and that growing market of borrowers that need money, but they also don't want a lot of hoops to jump through, and they want the money much faster in a very clean and easy transaction. So why does this matter? Let's talk about the home equity market landscape and how much that's shifted in the last few years. I'll be very brief with this slide because I think the next slide kind of helps spell things out a little bit more for today's topic. But I think what's really timely here is the slide that I showed a couple moments ago of fintechs doing things in 17 days. We understand there's a completely different regulatory landscape between those two types of institution types. We're not here to debate that today. But the fact of the matter is, fintechs are delivering a very fast, easy, quick solution to consumers. And they, I firmly believe, are changing the mindset of a lot of those younger generations that expect things quick and don't want to go to a branch and want things to be simple. The fintechs are, if anything, are changing the perception and the mindset of those consumers of, oh, this can be a quick transaction. This doesn't have to be complicated. This doesn't have to be, 500 questions that I answer inside of a branch. They are coming into this market by force. Rewind to 5 years ago, depositories, being banks and credit unions, held virtually 100% of this market, of the home equity market. Fast forward through the end of 2025, fintechs, non-banks have now eroded some of that share to depositories, and they have very quickly taken 20% share in this market. That is a very, very fast shift in a very short amount of time. Why does speed matter? Because we have so much more competition that are doing things so much differently than the legacy bank or credit union type of product. that we have to shift. We cannot be complacent given just how quickly this market and this landscape has shifted. So Jim, Barry, I'm going to get you involved here on this page, but just to kind of talk through this. This page is the problem statement, and this is the idea of why do we need to get better and why does speed matter. So I promised this page when I went over the previous views. So this isn't looking at a trend, this is looking at a 2025 summary of every single home equity transaction that closed throughout the year. So you see banks here, credit unions, and again, that fintech/IMB type of institution type. And this is showing where all of the deals are closing by that cycle time range. So that 1 to 15 days, we're 4% on banks, we're 1% on credit unions, we're almost 60% on that fintech IMB. And then again, in that 16 to 30, we're another 30%. So we're talking nearly 90% of their transactions are closing in less than 30 days. Virtually 60% are closing in less than 2 weeks. So Barry, I want to come to you with this question. You know, what do you think, what do you see as the single most impactful area of opportunity for depositories that they should consider in order to become more competitive in their cycle times? Again, not adopting a fintech model, that's not what we're here to suggest today, but you know, when you look at this and you look at the difference between a fintech and a bank and a credit union, you know, what are some of those biggest areas of opportunities that lenders here on today's call should be thinking about and can be doing, again, for this idea of incremental progress?
I think you're on mute.
You're on mute, Jim. Or
thanks for that. You know that was going to happen one time, right? You know, if you look at what we're working with as far as the different varieties of lenders that we work with and so forth, and I think it all comes down to workflow and how are loans processed internally within a client and what solutions are out there. So I think it's an analysis of the workflow, where are the choke points, if there are any choke points and so forth, be it either, you know, a product solution, be it a provider solution, be it a tech solution, and so forth. I think it's identifying and analyzing the internal workflows they have, find out where the delays may be, and then work to try to implement steps to improve it. As I mentioned earlier, around from the beginning, from application, on information that you get at application, information you get with title, how quickly you get that information from title, but all the way through the process as you get to closing.
Yeah, Ken, and I think that what we're seeing, and you know, obviously a lot of the factor, probably I'm sure your bank and credit union customers would basically let you know that these are my existing customers and we accommodate their pace, right? You know, that type of thing. It's not like the bank is not ready to do that, but you have the customer impact of that particular piece of it. I think one of the things that we're seeing, and we're strategically working with a lot of lenders and also applications, is the fact that there's a lot more done at the point of sale than so if you can push that information or push transactional workflow, to Barry's point, more at the point of sale, then you basically drive a little bit of a different outcome with that buyer, with consumer, making them aware of what's already done, what needs to be done, etc. And so basically what we're seeing is plugging our services into the point of sale, not just into the loan origination platforms for lenders, helps the lender add more velocity to what they're trying to do throughout the rest of the process, right? Because there's a lot of opportunity for the lenders to get, you know, verification of income, assets, employment, a number of those things right there at the point of sale. But if you can couple that with some more velocity on some of the other ancillary products and services that are part of the credit and underwriting decision, that's really what our goal, that's where we see plugging in, helping any of the customers in their journey for that particular piece of the process.
So a theme I'm hearing from both of you is, I think, two things. Number one, I think your Jim, what you offered up is, you know, fintechs would be more on like that digital scale of collecting more the right information earlier in the process, but also having those solutions, having those vendor solutions where it is accommodative to getting more information sooner in the process, so you can make a decision of, is this thing going to qualify or not? Number one. But number two, which path can this go down, my happy path, or does this need to go down my less happy path? I need to know this information today and not 2 weeks from now, and then just elongate this process.
Yeah, very, very well said. And really what that translates to, while your statistics showed the full cycle time from application to close, or the percentage of files that go from app to close, what we can tell you is that in working with our lenders and trying to drive best practices up front, what we're seeing is once we're engaged for services to close, we're seeing the rates somewhere between the mid to low 60s all the way up to 72, 75% of those transactions closing.
Wow.
So, to try and help drive, that was the other piece of the pull through. So the lenders do a good job of obviously mitigating things before that. But then I think as we supplement information further upstream to lenders, it just helps improve the pull through, which is obviously what the lenders want. They want the loan to close. They want the consumer to take a draw or whatever, what have you, in that particular process to activate the line and move it forward.
That's right. You said a key thing there, which we're going to hop into in a moment, of activating the line. In that, we can talk about a million different things today, but this delivering faster, easier to consumers, with the whole purpose of 4 HELOCs of delivering to customers that actually need money today, not maybe need money in 6 to 12 months from now. Great, thank you both for that. So one other interesting view as you think about, hopefully I've done a good job in helping paint the picture of how the landscape has shifted from, market players. But number two, it has been very conducive to the shift in preferences of consumers, especially with, younger generations preferring less branch, more digital type of solutions. But let's look at, what is the core fundamental difference between a fintech or a non-bank HELOC versus a depository HELOC. So a couple key things that I'll point out here, because I think there's a couple misconceptions on, banks versus non-banks is, banks tend to say, well, we go deeper into the credit box because these are all portfolio products, they're not saleable products for the most part, like most fintechs are. But just look at that weighted average credit score. I've said for a long time now and stand behind it, banks know what they like and they like what they know, and they tend to stick really firmly in that super prime credit space. So weighted average credit score 787, we've been sticking there for a very long time. But now look at fintechs and IMBs, that weighted average score is coming down to 735. So sorry, banks and credit unions, I love you. We work together all the time, but this is reflecting, this isn't just a one-for-one product and we just got a couple product features that are different. This is showing is a much more expansive credit box as well, not just a faster solution. So that's number one. Number two, and this really helps us kind of segue into the rest of our conversation this afternoon, is look at the differences between the products and actually what's delivered. So average line amount, 84K versus a depository 131K. We get that. We understand why that is there is generally a draw component to a non-bank HELOC versus a draw on demand feature for a depository HELOC. But at the end of the day, look at this, it's not only are they delivering faster and they're going deeper into the credit box, but that average balance of 78K, that average utilization of 93%, gosh, I know every single lender on this call would love to have 93% utilization rates. So this is kind of that intertwining of, why does speed matter? Because it's appealing to consumers that need money. They need money fast, and it's appealing to those consumers that have the debt that I started out this section of the conversation on. that portion of the debt falls squarely into those consumers that are demanding digital, non-branch type of solutions and products, and that's going to be more in that younger generation, less than 59 years old age bracket. So let's kind of move in the other direction here and really talk about that opportunity cost of speed. We understand speed matters. We understand it's a shifting landscape and shifting consumer preferences, but let's just talk about what's really on the table if I don't do anything with my cycle times and I stay content with 30-day, 40-day cycle times. So this data here is using our home equity portfolio data. As mentioned before, we can see everything that happens on a weekly basis. So we can see the demand, the ebb and flow of bookings. But now on a monthly basis, we have a benchmark of lenders, and then we can see the actual performance. So the utilization curves, we can see average balances and so on. So we took this data and kind of pushed it together and said, what does this data tell us of characteristics of borrowers that close in that 1 to 15 days versus borrowers that close in that 31 to 60-day window. Now, mind you, we didn't cheat. This is all depository, so I removed all the fintechs from this that have more of the required draw element. So this is all banks and credit unions. So here's what it tells us. Borrowers that you close within 2 weeks have a 42% likelihood to draw on that line. Borrowers that take over 30 days to close have an 18% likelihood to draw. So we're talking borrowers that you close fast. Not only are they more willing to take a draw, but they need to take that draw. They need that money fast. Borrowers that are willing to wait in line for 30, 40, 50 days is likely more of the crowd that they don't need money fast, or there is not an emergency and they don't have an imminent need to be able to take that draw. It's just, yeah, get it when I get it, and I'll take a draw when I need it, but there's not a need money type of factor today. So I think this is really a crucial element in really understanding, why does speed matter? Why should I be so focused on this? Why did Curinos and ServiceLink create a whole separate webinar dedicated to just why speed matters? I think it's this page right here, because you want to draw on those customers that actually need money, that actually can help boost your balance sheet and your overall profitability. Barry, walk us through a little bit on this, on the property information, and kind of as we think about, what we looked at on that last page of why speed matters, and kind of ServiceLink's approach to why speed matters through your solutions.
Yeah, and Jim referred to this, and Ken, you made reference as well. And this goes back to getting more data up front at point of sale, right? So this product here that we offer is an instant property information report that's returned to you in a matter of seconds, maybe a minute, on returning this data back to a lender to allow them to identify those loans that may fall out, right? Those loans that have complex information on a multiple mortgage, multiple involuntary liens, maybe taxes are delinquent and so forth, to make a determination if they're even going to push through with the transaction, but also to identify, conversely identify those loans that are going to be fast-tracked because the information is clear to you, right? They're entitled to the property, 0-1 mortgage, you want to be in second lien position, no involuntary liens, taxes paid, and so forth. So it's a two-pronged approach that our lenders are using this product for, to allow them to either push through and move forward, or push through and move forward quickly down a fast-track path to close as quickly as possible. Over 100 plus data points that we provide back with this particular thing, API'd right into a client's LOS. And then, everything looks good. The hope is then, and we have some clients using this, that they can go right to closing. They can at that point say, everything looks good here. I may still have to get a title report, property report, or an insured product and so forth, which will follow in ServiceLink's turn times anywhere from 3 to 7 hours, depending on the state. But also you can schedule the closing, right? So if you have exposure to our scheduling tool, everything looks good up front. You can, while you're talking to the consumer, then schedule that closing. Schedule it 5 days out, schedule it 4 days out. We work with lenders that are closing next day, based on information that they're getting and different things. So it allows you to push through and, ultimate goal: close loans quicker, push loans through faster.
Which to Barry's
Barry, I
point
can
is
appreciate
noted
what you said there.
Oops.
Please go ahead, Jim.
Yeah, no, I was just going to tie into what Barry was saying and like what you're talking about with speed and velocity, right? And that's where we've really noted the product as close now, because we want to give the lenders the tools to identify, and while it's shown here sort of like in that third segment, the real overall concept is close now. And so that's really where, and I think that hits with speed and the automation of processes. And as Barry was talking about sending data, really what we're also talking about with lenders is taking cost out of the equation, right? And you can take cost out by delivering data, running data against information that's already in the LOS, POS, et cetera, to eliminate functions such as title review that are done on the lender side to streamline that process, maybe not eliminate it, but streamline it, triage it, make it a very efficient process, to also get greater throughput and reduce the operating costs to fulfill the loan.
Love it. Great. Thanks, Jim. Thanks, Barry. So, so where do we go from here? We covered a lot, but I think there's a couple other points that we want to drive home here. I'm going to get Barry and Jim involved in here in a moment, but I want to give you a little palate cleanser before I hit you guys again with one more. Why does speed matter? This is taking the speed element out of it. And obviously, I'm not telling anybody here something you don't already know, but we all want to do things faster and more efficient. We all want to help our members, our customers. But I want to share some data I think is extremely compelling. Is why does speed matter in really helping those customers that need money fast? Because what our data shows us here on this page is the likelihood that of originating a borrower with a zero draw at close becomes a very grim picture the longer they sit on your book. So what we did with our data here, we took a cohort of second lien HELOCs that all had one common characteristic, which is they did not take a draw at the loan closing. And we followed that same cohort through 2 years on book. Just to hit the punchline here, once you hit MOB 18, once you hit MOB 12, the story doesn't change. You're still at over 40% of those same HELOC customers that didn't take a draw at close, still sitting at a zero position, a zero utilization position. If there's anything that you take away from this is, why should we improve cycle times, or why are the three of us so passionate about this, is because it's a behavioral challenge for consumers of you want to originate to those customers that don't need money. What you're going to get is just more of the inherent customer base that don't need money, and you're going to be challenged with this situation on the page more and more frequently, which is it's going to be really hard to get them to take a draw if they ever take a draw throughout the loan lifetime. We don't need to go through the financial economics of how profitable a zero balance HELOC is over the lifetime. It's not good. But as we transition back here to cycle time, one more that I wanted to show you here, and I'll get Jim and Barry, your perspective here just on the, once you've actually approved the loan, you go through all the work of actually going through all those steps and getting the loan approved. Now we have the task of actually getting that loan to the closing table and funding the loan. So what we're looking here is the bars are going to be representative of that total app to book cycle time average. The lines here for HELOC and HELoan are the measured days that we pulled from our data that's saying once the loan is approved, clear to close, as many of you might say, how long is it taking to actually get that customer into close, sign the documents through rescission period and funding to them? You're looking at HELOCs on average over 2 weeks, and you're looking at HELoans on average almost 3 weeks. That's a problem. That's a problem to the consumer. You've done all this hard work, and now you're stacking another 2 to 3 weeks onto the process. So Jim and Barry, I've got a question for you here, but as I think about that, I think back to our home equity summit, our client summit that we had last year, and we surveyed everybody that was in the room, 50 plus clients in the room. And we said, what percentage of you are you leveraging any sort of RON or e-notary services? The figures on the page speak for themselves. 62% of those that responded here saying they're not using it at all. And you've got some really, really low numbers there in terms of usage. So Barry, I think I'll hit you with this question. Why do you think lenders are hesitant, to using or pushing these products? Or maybe said differently, why do you think lenders lack the embracing of a RON or e-closings more than what's reflected here on the page?
Yeah, I think it's a couple different things, Ken. What we see, and again, wide variety of lenders, a pretty robust lender clientele group that we have. I do know that everybody is talking about it. Some are slower to adopt than others that have already adopted. But what I think there's a lot of lenders out there that feel it's a little bit more complex than it really is. They feel they may have to spin up a project and so forth in order to kick off e-closings and so forth. But if you choose the right provider who can take on a lot of the steps and the processes and so forth, I think you can get there much faster than I think some lenders realize at this point. We have a very mature e-closing solution. We've been using it for 6 years. And as I said, along with some of the other tools that we have lenders using multiple title providers, but we also have lenders using our tools, including e-closing, for 100% of their signings.
And I would
Barry,
add,
let's talk.
I was going to say, Ken, I would just add to that.
Sorry, keep going.
No, that's okay. I think there are also some, as Barry was talking about, there are some other barriers to adoption, right? So if you look at, obviously the depository lenders who are just going to hold the loan on their balance sheet, a little bit easier path to adopt an e-closing type strategy. If you have those lenders that are basically pledging loans to investors or other third parties who may have limitations around what they'll accept, that's what we've seen, particularly with a lot of the independent mortgage banks jumping in, some of those investors not permitting the e-close type of the process. The fintechs are obviously very aggressive in that particular space. And so to Barry's point, what we looked at is like, what are the challenges? How can we help the lenders through those challenges, while serving their current needs, whether we're closing, for example, just a traditional wet sign, or we do a lot with a number of banks where we actually will close within their branches and actually utilize their personnel if they want. And then obviously to this particular slide, talk about the E piece of it. So we're offering and looking to offer an e-vaulting, e-note type of solution to help those lenders get over those hurdles. To, as Barry's point, they have to spin up a bigger project. We can be sort of that middle ground to help them with that, to create adoption, drive consumer satisfaction, because at the end of the day, you do all these things, and to your point, speed matters, and it's the consumer experience on the back end of it that is also the tell as far as the level of satisfaction that they had. And if you can deliver a closing option, whatever it happens to be, in order to meet their expectations, then obviously you're sort of check off the list that you've basically accommodated what that customer has been looking for along the path, and hopefully get additional business or referrals out of it. So I think we've seen, I can tell you, just looking at our own statistics, we've seen over 100% growth in, I'm talking about very significant volume of RON closings from in 24, and more than doubling that growth in 25. And we're still on an upward trend in 26. So we are seeing, and that's very much home equity oriented. And so we are seeing greater and greater adoption of the RON process. To Barry's point, all the lenders are talking about it. We're seeing more people actually put their toe in the water and start doing it.
So Jim, we got a question in the chat, and just very timely. Question is, given that some counties do not accept e-notary for mortgage recordings, what additional strategies would you suggest to improving closing cycle times?
Yeah, so one of the things that we do as part of that Close Now product, Ken, is we basically also, we can not only deliver title information as data at the point of sale, but we can also provide an indicator at the point of sale if that county, state, and all the way down to the county level is eligible for an e-close solution. So the more that we can educate the lender and consumer up front, we can set up for a better experience all the way through the closing process. And so hopefully that is, would address that. We've received that question from a number of lenders. Hence, what we've done is we have a very active repository of information related to all the way down to the county level and the acceptability of an e-signed document for recording purposes. And so we know where to paper out, as well as obviously to be able to e-close. And I think that's an important first step.
Great. Thanks, Jim. I know we're coming up on time, and we promised everyone some takeaways. And we had a couple of ServiceLink pages. Anything in particular, on the closing, e-close, Exos, anything that you want to touch on before we wrap up here?
From my perspective, I think we touched on most of it, Jim.
Yeah, I would say one of the things that we're seeing in a lot of the new entrants in the market is they're looking to outsource more functions than have traditionally been done. And when I'm talking about that, obviously outsource the closing. So the closing going outside the branch network. And these are depository institutions as well as non-depository institutions, but then also buying other services such as the escrow function, funding services, post-close piece that basically is taking that process outside of the lender and putting it into a variable cost basis, so you don't have that fixed cost to do all those functions, and buying that service from ServiceLink on a per transaction basis. We're seeing a gravitation to that because lenders are obviously looking at the cost to produce a loan as efficiently as well as quickly as they can. So that's my wrap up, Ken.
Thanks, Jim. I think you stated that perfectly. As we think about what should lenders be focusing on right now, I think what you finished there with is perfect. So it's not in the best just in the best interest of the lender from a cost perspective, in the efficiency, but again, the end game is you're meeting more of that borrower need or that member need based upon their preferences, and what the data told us is really how they prefer to deal with their financial institutions. So quick summary for everybody before we hop. So hopefully we've delivered on cycle time's important. It's extremely important, and it's not just on the surface of just being able to do things faster, but 4 strategies that we hope that you can take away with. And we would love to have continued conversations with anybody that wants to reach out. But as Barry and Jim have very they've outlined here, just the different suites and solutions, like ServiceLink has meets you where you're at on what solutions you need to be able to deliver to be able to help that incremental progress. We have great data. We can help you where the problem statement is, where you need to work on. We would love to work with you there, but having that right suite of fulfillment solutions is absolutely key in making that first step towards that incremental progress. Jim touched on this earlier. Identify the borrower's need early in the process, get that information early, understand the need and the situation early. And again, having that right vendor that can provide you those solutions that can get you information sooner, faster in the process to be able to make that borrower experience better. Similarly, use vendors that provide you with property data fast and early in the process. Kind of both of those commingle there, but don't be satisfied with days. You heard from Jim. I didn't say it. Hours. You're talking about hours, not days. Find the right vendor that can help meet your expectations on speed and your borrower's expectations of needs, which is absolutely going to be hours, not days. And then lastly, use data intelligence to better understand your opportunity. Don't just, think you have a problem. Understand exactly where your opportunity is to be able to drive value for your members and know what areas across your fulfillment process that you can improve on. Jim, Barry, I want to thank you for your partnership. Thank you for your time and insights today. And thank you for everybody for joining today's call. Hope you had some great takeaways. You have our contact information here, me at Curinos, and then you have Jim Barry at ServiceLink and our contact information. For anyone on the call that's going to be at CBA, come talk to us at Curinos or the folks at ServiceLink. We'll both be there. But if anyone has any specific questions on today's topics or wants to have a further conversation, please reach out to us. Otherwise, thanks for your time and attention. And Barry, Jim, thank you again for your time and consideration today. Hope everybody has a wonderful afternoon.
Thanks,
Thanks, Ken.
Thanks, everyone.
Thank you.